In 2026, investing is no longer just about picking a few popular stocks and hoping they go up. The market is changing faster than ever. Artificial intelligence is transforming industries, interest rates are still impacting the economy, and global uncertainty continues to create volatility across financial markets. But despite all the noise, one thing remains true. The investors building long-term wealth are the ones following a smart portfolio strategy. In today's video, we're breaking down the ultimate portfolio strategy for 2026, from beginner investors all the way to pro-level wealth builders, so you can grow your money while managing risk in one of the most important investing years ahead. Let's start with the biggest mistake most people make. They think investing is about finding the next hot stock or chasing quick profits. But real wealth is usually built through portfolio construction, not gambling. A strong portfolio is designed to survive market crashes, benefit from long-term growth trends, and compound steadily over time. In 2026, diversification matters more than ever because markets can shift rapidly overnight. One sector might explode higher while another collapses. Smart investors don't put all their money into one idea. They spread risk strategically across multiple assets. If you're a beginner investor, your main goal should be building a strong foundation. You don't need complicated strategies to start growing wealth. In fact, simplicity often wins. A beginner portfolio in 2026 should focus heavily on broad index funds and ETFs because they instantly diversify your money across hundreds of companies. A simple setup could include around 60% in a total US stock market ETF, 20% in international markets, 10% in dividend-paying stocks, and 10% in bonds or cash for stability. This approach gives you long-term growth potential while reducing unnecessary risk. One of the most important lessons for beginners is avoiding emotional investing. Social media constantly pushes risky trades, meme stocks, and get-rich-quick stories. But the truth is, consistent investing usually beats emotional investing. Investors who keep adding money month after month, regardless of whether the market is up or down, often outperform people trying to time the market. This strategy is called dollar cost averaging, and it remains one of the most powerful investing habits in 2026. Now let's move to intermediate investors, people who already understand the basics and want higher growth opportunities. In 2026, some of the biggest opportunities are in artificial intelligence, cybersecurity, robotics, energy infrastructure, healthcare innovation, and semiconductor companies. An intermediate portfolio could look something like this: 50% in core index funds, 20% in high-growth sectors like AI and technology, 15% in dividend stocks, 10% in international exposure, and 5% in alternative assets such as gold or crypto. As your portfolio grows, protecting wealth becomes just as important as growing it. In 2026, market volatility is expected to remain high because of economic uncertainty, geopolitical tensions, and rapid technological disruption. Now let's talk about pro-level portfolio strategies. Professional investors think differently from beginners. They focus on asset allocation, passive income, tax efficiency, and long-term wealth preservation. Another major difference between average investors and professionals is emotional control. Professional investors stay focused on long-term trends instead of short-term fear. They understand that market downturns are normal and often create opportunities. At the end of the day, the ultimate portfolio strategy for 2026 is not about chasing hype or trying to get rich overnight. It's about building a diversified, balanced portfolio that matches your goals, risk tolerance, and time horizon.